Hello, everyone. I'm John, lead analyst and founder of JP Strategic Investments. And today I'm going to walk you through why we make earnings trades and some of the different strategies we use. But before we do that, I want to make sure that you guys know that options trading is very complicated and it can be very risky without proper experience. So make sure that you have a good understanding of options before you make any options trades. Also, keep in mind that the examples we go over in this video are not trade recommendations. They're simply meant to help you visualize the strategies that we're demonstrating. All right, now that we've got that out of the way, let's dive right in. So let's start with the first question. Why do we make earnings trades? It's a fair question because many investors see earnings trades as unnecessarily risky or even gambling. So let's take a look at the facts. When companies report earnings, their stocks often make large moves in one direction depending on whether the company beat expectations or missed. This provides opportunities and risks. Obviously, if you're able to correctly predict the direction of the movement and better yet the magnitude, then you can make a lot of money. That's very hard to do though, and that's why many investors tend to stick to long-term investing and they just ride out the short-term ups and downs of earnings rather than trying to make risky bets based on short-term predictions. So with that said, when we make earnings trades, we have to make sure that we balance the opportunities with the risks. We do this by employing different strategies for different situations. I'm going to walk you guys through 4 basic strategies we use around earnings and give you some examples of the situations when we would use these strategies. I'm going to use the Robinhood platform to demonstrate these strategies, not because it's the platform we use, but because we think it's the simplest platform and makes it easy to illustrate these strategies. So the first situation when we make earnings trades is if we think a stock will make a large move up or down and we don't currently hold a position in the stock. In this case, we are simply trying to capitalize on a large short-term move in the stock. In these situations, we look for stocks whose options are undervaluing the move that we anticipate and are therefore cheap. We generally do this with simple puts or calls or debit spreads if the implied volatility makes simple put or call strategies unprofitable. To show you an example of this, let's take a look at Uber. Uber is reporting earnings tomorrow, so we picked this stock to make this as realistic an example as possible. So for example, let's say that we've been following Uber for a while, and we think that based on the research that we've done, we believe they will report a big surprise beat in their earnings or come out with some great news about their business. Keep in mind that we only make these trades when we are very confident in our predictions. So let's say that we thought Uber stock was going to have a huge jump around 20%. Well, Uber right now is trading at $34.71. So a 20% jump would put the stock at $41.65. So the basic strategy here is to find options or a combination of options that allow us to make good profits, but that don't cost too much. Generally, as a rule of thumb, we like to make at least 3 or 4 times our money on these trades, or we won't make them. Because these trades don't have a high probability, we want to make sure that we're getting a good payout if we're right. That way, even if we're only right 30% of the time, we can still make good profits. So if we look at their options chain, we can see that we can buy the $36 call for $136, and if we sell the $40 call for $46, we can create a debit spread that only costs us a total of $90. The total possible value of this position if the stock moves above $40 or 15% is $400. Now the graph here shows the performance of the option as the stock moves up and down. The horizontal line in the middle measures Uber's stock price with negative movements on the left and positive movements on the right. The vertical axis on the left measures how much profit or loss the position makes in correlation to the stock moving up or down. So essentially, if we're right, we could make up to $310 in profits, which is 344% in gains. Another thing you'll notice about the graph here is that the stock only has to move up about 7% for the position to be profitable. One thing that new traders often take for granted about earnings trades is employing a spread like this where we sell the $40 call. While selling the $40 call limits our gains, it greatly reduces the cost of this trade. And if you don't think that the stock will go much higher than $40, then it's a no-brainer to sell the $40 call and take the extra $46 credit. Finally, this strategy is easily scalable to fit your portfolio size. All you have to do is buy more contracts. The next situation in which we might make an earnings trade is if we currently hold a long-term position in a stock and we think that there is a possibility that the company will have a big upside surprise on their earnings because of financial reasons or because they might make a big announcement, just like in the previous example. A great example of this is Tesla. Tesla's earnings are always highly anticipated, and Elon Musk is known for his showmanship. Not only that, but the stock is often heavily shorted, meaning that a huge positive movement in the stock could cause a potential short squeeze. So knowing this, if we think that Tesla has a high probability of reporting a large upward surprise, then a strategy we might employ is keeping our shares and buying far out of the money calls or call spreads. They aren't reporting earnings this week, but their IV is already high, and we're going to take a look at options 2 weeks out here to make the prices more realistic. So the first thing we need to figure out in a trade like this is how much we think the stock will jump based on the news we think that's going to come out. This really depends on the situation, but for this example, we'll say that we're expecting a 20% move. So what we want to do is take a look at the options here and figure out what options or combination of options allows us to take advantage of a very large move in the stock, but still is relatively cheap. So let's assume that we have 100 shares of Tesla. In a strategy like this, we generally only like to risk 2 to 3% of our position on the options. So Tesla right now is trading at $1,485 a share. So we know that a 20% move will put the stock at about $1,782. If we look at the options here, we see that we can get the 1650 call for about $1,000. If we buy 2 of these contracts, that will cost us just under $2,100, and that's only 1.5% of our current stock position. That's under our budget and allows us to greatly increase our profits on this position if the stock jumps on surprise news. If we take a look at the graph here, we can see how this position with options will perform compared to the stock only position. We can see that if the stock drops or doesn't move too much, then the position supplemented by options takes on only 1.5% more losses than the stock only position. Whereas if the stock jumps 15 or 20%, the position supplemented by options can make up to $26,000 or 18% more than the stock only position. This means we're getting exactly what we want out of the options. They're allowing us to greatly increase our profits if the stock jumps, while only risking a small amount. These next 2 situations that we'll go over are where the investors I mentioned above would have the strongest argument to say, why waste money trying to time the short-term move? Just hold your shares, and whatever movement happens now won't make too much of a difference in the long term. Well, every situation is different, but for the most part, we tend to disagree. The first of these situations is one in which we hold a long-term position in the stock, and we think that the upcoming earnings will most likely cause a large upward or downward move in the stock, and we aren't sure necessarily which one it will be. In this situation, we think it's actually better to sell all your shares and make an options trade rather than just to hold on and ride it out. We actually did this with Tesla's earnings recently, so we'll use their options chain as an example again. Tesla's earnings, like many others during this pandemic, have been very hard to predict. Their last earnings were highly anticipated because if they reported GAAP profitability this quarter, that would mean eligibility for the S&P 500, which would cause the stock to run up over 50% in the month prior to their earnings. Combine this with the fact that the stock was also being heavily shorted, and you create the perfect storm in which bad earnings cause a 20% plus drop, whereas stellar earnings could drive the stock up another 20 to 30%. In this situation, what we decided to do was sell out of our current position in the stock and then buy specific options combinations to allow us to take advantage of a large upward move while still limiting our downside risk if the stock were to drop. Here's an example of how this would work. So Tesla is currently trading at about $1,485 per share. If we assume that we have the same 100 shares as we did in the last example, then we would have $148,500 in the stock. And if we look at Tesla's stock, we see that a 20% jump would put the stock right about $1,782 per share. Now, obviously the stock may only jump 10 or 15% on good earnings news, so we have to figure out how much of a move we are okay missing out on. Because, for example, if we bought the $1,700 calls, and we don't own any of our shares, then even if the stock jumps up 15% to $1,699 per share, then we actually lose all of the money we have in the options, and we don't make any of that money from the shares we had because we sold the shares. So once we figured out that we're okay missing out on a 7% move, we can figure out that 7% is right around $1,600 per share. So if we look at the options chain, we can figure out that the $1,600 call is trading at just over $1,700. If we buy 3 of these, that would cost us about $5,130. Now, let's compare how the position of 100 shares would perform as opposed to just the position of these options in a few different scenarios. In this graph here, the blue line graphs the performance of the options position, and the red line graphs the performance of the stock position. So let's say we do get that 20% jump in the stock, and it goes to $1,782 per share. Well, that would mean that if we own the 100 shares of Tesla, we would make $29,700. That's pretty sweet, right? But if we look at the options position, we would make $54,600 because each of these options would be worth $18,200. That's almost $25,000 more than we would make with the 100 shares. In fact, you can see that the options position outperforms the stock position on any upward move over 12%. Now, on the flip side, if the stock were to drop 20%, then the stock position would take a loss of $29,700, whereas the options position would only take a loss of $5,130 because that's all that we spent. You can only lose the money that you spent on the options. For comparison, that's only 3.5% of the $148,500 in the stock position. So essentially what we're saying by choosing this options position is there's a high probability that the stock will make a large move up or down after earnings. I don't want to take too much risk, but I also don't want to miss out on a big jump in the stock. So I'm willing to risk 3.5% of my position and potentially miss out on an upward move of 7%. But in return, I get to cap my losses at 3.5% no matter how low the stock goes, and I still make huge profits if the stock makes a large upward move. I think most people would agree that in this type of situation, the options position is better. Now, in the last situation that we would make an earnings trade here, we're looking at a long-term position in the stock, and we think that the upcoming earnings report will most likely cause a larger drop in the stock. Now, just to clarify, if we think that there have been changes in the company's fundamentals that nullify our long-term bullish thesis, or if we're almost positive that the stock will take a large move on the downside, then we'll most likely just exit our entire position. But if we think that there's just maybe a possibility of a short-term drop in the stock that doesn't affect our long-term outlook, then what we'll do is usually keep our current position in the stock, but buy out of the money put options to hedge our position. This way, if the stock drops, we cover some or all of our losses. So for this situation, we'll go back to Uber, and let's assume that we have 1,000 shares in the stock. Now, with this strategy, we usually have a long-term outlook, as I mentioned before. So we don't necessarily mind if the stock drops 5 or 10% in the short term, and we might even welcome it as an opportunity to add more shares if our long-term bullish thesis stays intact. That being said, we don't want to lose much more than 10%. So what we're looking for in these options is essentially a way to cap our losses at 10%, even if the stock goes significantly lower. Uber is currently trading at $34.71, so a 10% drop would put the stock at about $31.24. If we look at the options chains here, we can see that we can buy the $31 put for $59. If we buy 10 of these contracts, we are able to limit our losses on this position to roughly 13%, no matter how low the stock goes. Plus, the $590 spent on these contracts is only 1.6% of our current position. So if the stock stays flat or even goes up, that means we're only reducing our gains by 1.6%. This strategy, like any of the previous ones, can also be adjusted to fit your needs. If you want to limit your losses to only 7% or maybe take as much as 15% of a loss, then all you have to do is choose the corresponding put options. Now, there's a couple more things to keep in mind when it comes to earnings trades. Generally, we like to enter these trades as close as possible to the actual earnings report, so that we can limit the possibility of any other outside events affecting these trades, and also so that we can enter these trades at the cheapest point possible after theta has taken as much of an effect as possible. Also, while these are some of the strategies we use, they aren't the only ones, and we often adapt these strategies to fit specific situations. So if you want to get access to all of the earnings trades we make when we make them and our reasoning behind them, you can leave us a comment below or message us on Facebook, and we'll send you an invite to our Discord server where we post notifications and explanations whenever we're making earnings trades. All right, well, that's it for this video. Be sure to hit the like button if you found this video helpful, and check out our website or YouTube channel for more stock analysis and trade information. Have a great day, everybody.